Something strange is happening inside Bitcoin right now, and almost nobody outside the crypto world has noticed it yet. It isn't a hack. It isn't a new regulation from Washington. It isn't a billionaire tweeting something reckless. It's a quiet argument between the very people who built Bitcoin software, and that argument could decide what Bitcoin actually becomes for the next 50 years. Before we go any further, quick disclaimer, because this channel takes that seriously. Nothing in this video is financial advice. We're not telling you to buy, sell, or hold anything. This is an educational breakdown of what's happening inside Bitcoin's community, told in plain language, so you can form your own opinion. Always do your own research before making any financial decision. Now, with that out of the way, let's get into it, because this story is bigger than most headlines are giving it credit for. If you're new here, welcome to the Wealth Continuum, where we don't chase hype, we chase the forces actually shaping money, markets, and the future of wealth. And if that sounds like your kind of channel, you might want to stick around, because by the end of this video, you'll understand something about Bitcoin that maybe 1 in 100 investors currently understands. Quick question before we start. What are you doing while you're watching this right now? Are you at your desk pretending to work, lying in bed scrolling before sleep, driving and just listening? Type it in the comments. I actually read them, and it helps me understand who's watching this channel. Okay, let's talk about Bitcoin. For roughly 17 years, Bitcoin has taken punch after punch and somehow kept standing. Governments tried to ban it. Traditional banks called it a fraud. Famous economists declared it dead more times than anyone can count. Entire countries outlawed mining within their borders. Major exchanges collapsed overnight, taking billions of dollars down with them. And every single time, Bitcoin got back up. But here's what makes today's situation genuinely different from anything that came before it. This time, the people causing the disruption aren't trying to kill Bitcoin. They're trying to protect it. Two completely different camps of developers, both convinced they're saving Bitcoin from the other side. And that, strangely enough, might be more dangerous than any external attack Bitcoin has ever faced. Right now, Bitcoin's total market value sits somewhere around $1.1 to $1.2 trillion. Even after a rough stretch this year that saw the price fall from highs above $93,000 in January down into the $58,000 to $60,000 range by early July. That's not a small correction. That's the kind of drawdown that makes headlines on its own. But stay with me, because the price swings aren't actually the main event here. Underneath all of that volatility, a much quieter and much more consequential battle has been unfolding inside Bitcoin's own code. Depending on how it resolves, it could reshape what Bitcoin is allowed to be used for forever. So here's the real question we're going to answer today. What is Bitcoin actually supposed to be? A savings technology and nothing else? Or an open highway that anyone can use however they want, as long as they pay the toll? Hold that question in your mind, because by the end of this video, you'll have a much clearer answer than most people scrolling through crypto Twitter right now. Let's simplify this with a picture, because the technical version gets messy fast. Imagine you spent 17 years building the most secure vault the world has ever seen. Every year, it gets a little stronger, a little more trusted. Eventually, the wealthiest people on the planet start storing their savings inside it. Big financial institutions move billions of dollars in. Some governments even start quietly discussing whether they should keep a portion of their reserves in that same vault. Then one day, people stop filling it with only gold and start stuffing it with old photographs, random videos, digital trading cards, and text files that have nothing to do with money at all. The vault still works. It's still secure. But now it's being used for something completely different than what it was built for. That's the simplest way to describe what's happening inside Bitcoin. Now, not everyone agrees with that picture, and honestly, some developers would push back on me hard for using it. Their argument goes something like this. Bitcoin is permissionless, meaning if you're willing to pay the transaction fee, you should be allowed to use the network however you want. Sending money, creating digital collectibles, storing a document forever, none of it should require anyone's approval. And that raises an uncomfortable question. Who exactly gets to decide what counts as an acceptable use of Bitcoin? Here's the answer, and it's the part most new investors never fully grasp. Nobody decides. There's no CEO of Bitcoin, no headquarters, no president who can call a meeting and settle the matter. Power is scattered across thousands of independent people, developers who write the code, miners who secure the network, regular people who run nodes and verify every single rule for themselves, businesses that build on top of it, and millions of everyday users who ultimately choose which version of the software they trust. It's slow, it's frustrating, it's occasionally chaotic. But that exact messiness is the reason Bitcoin has stayed decentralized for so long, when almost everything else in finance eventually gets controlled by somebody. And right now, for the first time in years, those groups genuinely disagree about where Bitcoin is heading. Here's where it gets interesting, so stay with me for one more minute before we jump into the actual proposal causing all this noise. This isn't the first time Bitcoin has nearly torn itself apart over a philosophical disagreement. Almost a decade ago, something eerily similar happened, And a lot of people watching this video weren't even in crypto when it occurred. The way that earlier fight ended shaped the Bitcoin you know today, and it might be the clearest clue we have for how this new battle plays out. But first you need to understand what actually lit the fuse on this current argument. It didn't start with a scandal. It started with one tiny, mostly ignored feature buried inside Bitcoin's code, something almost nobody paid attention to for years, until people realized it could be used in ways its original creators never imagined. So here's the mechanism at the center of everything. For most of Bitcoin's history, transactions carried only the information needed to move money from one wallet to another. Simple, efficient, nothing extra attached. But developers being developers, someone eventually figured out how to attach much larger chunks of information onto a Bitcoin transaction. Not payment data. Images, text, digital art, entire files, even short video clips, technically. Suddenly, Bitcoin wasn't just behaving like digital money anymore. It was starting to resemble something else entirely, a permanent, unchangeable filing cabinet that anyone on Earth could add to. Supporters were thrilled. More activity, they argued, means more transaction fees, and more fees means stronger financial incentives for the miners who secure the whole network. Sounds like a reasonable trade, right? Hold that thought, because critics noticed a much bigger problem hiding underneath the excitement. Every single piece of data added to Bitcoin has to be stored, verified, and preserved by thousands of independent computers scattered across the world. Not for 5 years, not for 20 years, permanently, forever, as long as Bitcoin exists. And that raises a question that should genuinely concern anyone holding Bitcoin for the long term. What happens if Bitcoin slowly transforms from the hardest form of money the world has ever created into an increasingly expensive and bloated storage drive? Does that push the cost of running a full node higher? Does it quietly discourage regular people from participating? Does it slowly nudge Bitcoin's decentralization toward large, well-funded data centers instead of ordinary individuals running a node from their spare bedroom? This is where it gets really concerning, because those questions eventually led directly to a proposal that's been quietly dividing the Bitcoin community for months now. It's called BIP-110. Let's break down what actually happened, because the timeline matters here. Earlier this year, Bitcoin Core, the most widely used software that runs the network, released a major update that removed the old 80-byte limit on a feature called OP return, a small, clearly labeled space inside a transaction meant for attaching non-payment data. Removing that cap meant people could technically attach far more data than before, using a method that's actually less harmful to node operators than the workarounds people had been using to stuff data elsewhere. To one camp of developers, this looked like a sensible cleanup, channeling data usage into the least damaging corner of the system instead of pretending the demand for it would simply disappear. But to another camp, led most visibly by a longtime contributor named Luke Dashter, this looked like something far more troubling. Like Bitcoin Core was quietly waving in an entire category of activity that has nothing to do with Bitcoin's original purpose, as sound, minimal monetary infrastructure. In response, a proposal appeared in the official Bitcoin Improvement Proposal repository, filed under the name Reduced Data Temporary Soft Fork, and known publicly as BIP-110. It's a genuinely technical proposal, but the plain language version is this. It would temporarily tighten the rules around how much non-payment data can be squeezed into a Bitcoin transaction, essentially pulling back some of what the recent update opened up. Supporters describe it as a short-term emergency brake, something to protect Bitcoin's core purpose while the community figures out a longer-term solution. Critics describe it as rushed, disruptive to legitimate applications already built on top of Bitcoin, and dangerously close to letting a small group of developers decide what counts as an acceptable transaction, something Bitcoin was specifically designed to avoid. Here's the twist that makes this genuinely fascinating, instead of just another Twitter argument. Support for BIP-110 has been tracked through something called node signaling, where operators of the software can publicly indicate whether they back the change. And that signaling data has actually become a controversy of its own, with prominent Bitcoin researchers publicly questioning whether some of the apparent support is being artificially inflated by a small number of people, running unusually large numbers of nodes to make the movement look bigger than it really is. So even measuring how much support this proposal actually has turned into its own miniature battle. And here's what almost nobody outside the developer community understands. Developers can write all the proposals they want. They cannot force Bitcoin to do anything. Writing a proposal is a bit like drafting a new constitution for a country you don't govern. It's easy to write the document. Convincing millions of independent, stubborn people to actually adopt it is an entirely different challenge. In the next section, I'll show you why a proposal that currently has relatively modest direct support could still end up mattering enormously, why Wall Street has been almost eerily quiet about the whole thing, and what that silence is actually telling us. Here's what genuinely surprised me while researching this whole story. If a proposal exists that some developers believe could reshape Bitcoin's identity or even risk splitting the network the way it split back during the 2017 block size wars, you'd expect the world's largest financial institutions to be sounding alarms. BlackRock manages trillions of dollars in assets. Fidelity has built an entire business line around Bitcoin products. Public companies now hold enormous amounts of Bitcoin directly on their balance sheets. These institutions employ armies of analysts whose entire job is identifying risk before it becomes a headline. So why has their public reaction to BIP-110 been essentially nothing? I think the honest answer is this. Institutions aren't buying Bitcoin because they want a place to store internet memes or digital collectibles. They're buying it for one reason and one reason only: scarcity. 21 million coins. Ever no central authority that can print more. That fundamental thesis hasn't shifted because of one software proposal, and it likely won't, regardless of how this particular argument resolves. While the Bitcoin community argues about code, institutional money has spent the last few months focused on something else entirely, something with a far more direct and immediate impact on price. Stay with me here, because this next part connects directly to what's happening in your portfolio right now, whether you hold Bitcoin or not. The first half of this year has genuinely been rough for Bitcoin. After opening the year above $93,000, the price steadily eroded, closing out June around $60,000, its lowest level in close to 2 years. Most of that pain traces back to two forces that have nothing to do with BIP-110, Federal Reserve policy, and money leaving the spot Bitcoin ETFs. June alone saw the largest monthly outflow from United States spot Bitcoin ETFs since those products first launched, somewhere near $4 to $4.5 billion leaving the funds, with BlackRock's IBIT, the single largest Bitcoin ETF on the market, accounting for a huge share of that exodus. Here's the part that should genuinely make you pause and think. Even while all that institutional money was heading for the exits, on-chain data from firms tracking large wallet activity showed Bitcoin whales quietly accumulating more than 270,000 Bitcoin over a 2-week stretch. Big money was leaving through the ETF door, while different big money was buying directly on-chain. What does that tell you? Comment below what you think that split actually means, because there are at least two completely different ways to read it, and I genuinely want to know which one you believe. Meanwhile, all eyes are now on the Federal Reserve's meeting scheduled for the 28th and 29th of July. A softer tone from the Fed could send ETF money flowing back in and give Bitcoin room to reclaim the $62,000 to $64,000 resistance zone. A hawkish surprise could just as easily push Bitcoin toward the mid-$50,000 range or lower. None of that, notice, has anything to do with a technical debate over how much data fits inside a transaction. But here's what they're not telling you in most of the mainstream coverage of this story. This isn't really a fight about profits or price charts or quarterly ETF flows. Underneath all of that, it's a fight about identity. One side genuinely believes Bitcoin only survives long-term if it stays laser-focused on being the hardest, simplest form of money humanity has ever built. Nothing else. The other side genuinely believes Bitcoin's real strength has always been freedom, the idea that if you're willing to pay the fee, nobody gets to tell you what you can or cannot do with the network. Both sides think they're protecting Bitcoin. They just disagree completely on what exactly needs protecting. And here's a lesson from history that I think gets overlooked constantly. The monetary systems that have survived the longest didn't survive, because everyone inside them agreed on everything. Gold has held value for thousands of years, not because it never faced challenges, but because the specific qualities people valued about it, scarcity, durability, universal recognition, never disappeared no matter how the world around it changed. Bitcoin is facing its own version of that test right now. Can it evolve at the edges without losing the qualities that made people trust it in the first place? That question matters far more than whether BIP-110 specifically succeeds or fails. Quick check-in, by the way, because we're deep into this one. How's the weather where you're watching from today? I'm always curious how spread out this audience actually is. Drop your city or country in the comments. It's genuinely one of my favorite parts of reading through them later. All right, let's keep going. Because there's one more layer to this story that almost nobody is talking about, and it might actually be more important than everything we've covered so far. So could this entire disagreement actually break Bitcoin apart? It's a completely fair question, and the honest answer is that nobody knows for certain. But history offers something useful here. Bitcoin has never gotten stronger because everyone suddenly agreed on something. It's gotten stronger because disagreements had to be resolved without anyone having the power to simply force a decision through. Think about how unusual that actually is. Every traditional financial system eventually has someone who makes the final call. A central bank, a finance minister, a chief executive, a regulator with enforcement power. Bitcoin has none of that. Its greatest strength, and simultaneously its most maddening quality, is that nobody gets to just decide. Consensus has to emerge slowly, sometimes painfully, through incentives, competition, and voluntary participation. That's exactly what happened during the 2017 block size wars, when Bitcoin faced a nearly identical structural argument over how large individual blocks of transactions should be allowed to grow. Developers fought publicly for months, businesses picked sides, and plenty of people assumed Bitcoin would never fully recover from the split. Eventually, the network did split, giving rise to Bitcoin Cash as a separate chain, while the original chain continued on as Bitcoin. Rather than destroying confidence in the system, the split arguably proved the opposite point. Investors voted with their capital, businesses voted with their infrastructure, users voted with their continued trust, and the original chain kept its dominant position. There's one enormous difference this time around, though, and it's worth sitting with for a second. Back in 2017, Bitcoin was still a relatively niche financial experiment worth a small fraction of what it's worth today. Right now, it's a $1 trillion-plus global asset, sitting inside pension funds, corporate treasuries, retirement accounts, and increasingly, government discussions about strategic reserves. Millions of people indirectly hold exposure to Bitcoin through funds and accounts they don't even actively manage themselves. Which means whatever happens with this current debate doesn't just affect crypto forums anymore, it ripples outward into portfolios belonging to people who've never heard the term OP return in their lives. Now, here's the part that developers privately worry about far more than BIP-110, and it rarely makes it into mainstream coverage at all. Quantum computing. Let's put this in perspective, because I don't want to overstate it. This isn't a next month problem, and it probably isn't even a next few years problem. But unlike the current data storage debate, a sufficiently advanced quantum computer could, in theory, eventually threaten the cryptographic foundations that secure every single Bitcoin wallet on Earth. That's exactly why researchers inside the Bitcoin ecosystem are already exploring quantum-resistant cryptographic approaches, years before this becomes an urgent concern. That's not a sign of weakness. It's what mature, long-term systems are supposed to do. They prepare for distant risks, well before those risks become emergencies. Here's my honest conclusion after digging through all of this. The real reset happening around Bitcoin right now isn't happening inside its code at all. It's happening inside the broader global financial system. Government debt keeps climbing to record levels across major economies. Currencies keep losing purchasing power in ways that are increasingly hard to ignore, and investors everywhere are rethinking what actually qualifies as a dependable long-term store of value. Bitcoin, meanwhile, has quietly transformed from an obscure experiment among programmers into an asset that central banks discuss, that public companies hold directly, and that increasingly gets mentioned in the same breath as gold. That transformation is the real story, not one proposal, not one internal disagreement, but a genuine shift in how large parts of the world think about money itself. And maybe that's exactly why this particular internal debate feels so loud. Because Bitcoin isn't a niche technology conversation anymore. It's become part of a much bigger financial conversation. And when something reaches that scale, every disagreement inside it suddenly carries more weight than it used to. If you came here hoping for a confident prediction about where Bitcoin's price goes next, I'll be straight with you. Nobody actually knows that with certainty. Short-term price action gets pushed around by liquidity conditions, interest rate decisions, ETF flows, and plain sentiment. But if you're thinking in 5, 10, or 20-year terms, the questions worth tracking look completely different. Is Bitcoin's scarcity still intact? Is real adoption still expanding, not just price speculation? Are institutions still allocating capital over multi-year horizons? Are developers still actively working to strengthen security? Is decentralization actually being preserved or slowly eroding? Those questions matter far more than any single week's headline, including this one. So here's my final thought before we wrap up. Years from now, this might just be remembered as another chapter in Bitcoin's long history of internal arguments, one that ultimately changed very little in practice. Or it might be remembered as one of the genuinely defining moments, a point where Bitcoin had to answer, once again, one of its oldest and most uncomfortable questions. What exactly is Bitcoin supposed to be? Only time actually answers that one. But here's what the history consistently shows us. Every single time people predicted Bitcoin's collapse, they were wrong. Every time. Maybe this disagreement ends differently. Or maybe it's simply another reminder that Bitcoin's greatest strength was never perfect agreement among its users. Its greatest strength has always been that no single person, company, or government gets to unilaterally decide its future. The network decides, the market decides, and ultimately, millions of ordinary people deciding individually decide. That's not a design flaw. That's the entire point of the thing. So now, I genuinely want to hear from you. Do you think Bitcoin should stay laser-focused on being the world's hardest, simplest money? Or should people have complete freedom to use the network however they choose, as long as they're willing to pay for the space? And here's the bigger question underneath all of it. Do you think this debate actually changes Bitcoin's long-term future? Or is this just another chapter that gets forgotten in a year? Answer honestly in the comments. I read every single one, and I'll respond to as many as I can. If this kind of deep dive is what you come here for, hit like right now. It genuinely helps this video reach more people who'd find it useful. Subscribe if you want more breakdowns like this one, because on the wealth continuum, we don't just chase headlines, we dig into the actual forces shaping money, markets, and the future of wealth before most people are paying attention. And if you know someone who owns Bitcoin but has never even heard of BIP-110, share this with them, because they genuinely need to see it. One more thing before you go. Some analysts believe the next major wave of global liquidity could end up being an even bigger catalyst for Bitcoin than anything we covered today. That's exactly what we're breaking down next, so you won't want to miss it. I'll see you in the next one.